Here's the good thing about history and mindset and psychology is usually the fear is much greater than the end reality. We saw it during COVID. We've seen it during multiple market crashes, multiple scenarios. Usually the fear is greater and more far reaching than the end reality.
Hey, everybody. Welcome to the 0 to 100 podcast. This is the leader, the number one, the host, Travis Dillard.
Thank you for the intro.
And this is Mitch. So we've got a unique format today. Gabe is gone. He's in Cabo living his best life. And I guess we've all been doing some lifestyle stuff.
Yeah.
I was in London a week or so ago. You were out running around the country.
Gallivanting.
In a disgusting manner in your RV. And Gabe is out. He's in Cabo. And so we were going to, Mitch loves to be around me. He loves to come over to my house. He loves to eat all my food. He loves to
just a dysfunctional relationship.
Yeah. So we were going to he was going to stay home and do the podcast. And I thought, well, let's try and just do it in my office. And so we've got the mic, we've got the whole thing. We're going to gaze into each other's eyes and we're going to talk real estate. For those of you that are listening and want to know what the 0 to 100 podcast is, we are all about buy and hold cash flow real estate, or are we? That's a topic we're going to talk about today. But we're all about using the vehicle of real estate to achieve retirement number one, where all of your living and lifestyle expenses are covered through passive income off real estate, or maybe active income off real estate. That's a topic we're going to talk about today. Either way, how do you use real estate to live your biggest and best life? We love real estate. I drive down the road, man. I see a mobile home park. My daughter says, look, Dad, mobile home park. I see apartment complex.
That's wired for now.
Right. I see storage. I'm always looking at office, industrial spaces. I love real estate. It's a tangible asset. It has inherent value. Yes, there's emotions that drive prices up and down, but man, what a crazy time we're dealing with right now. We're the 8th of April.
Yeah. A lot going on.
There's a lot going on. I've been watching the stock market just, yo-yo. It's like,
well, fear has entered the market and the fearful are controlling it at this point. I mean, you've seen a huge crater, I think, as a result of a lot of things, but tariffs is the main thing, which I think we'll dive into today. But yeah, fear is prevalent right now.
And I'm a real estate and a business guy. I've never understood the fact I went in, I sold the company, and I put a decent amount in the stock market and then lamented every single day about it.
Yeah, you're not a stock guy.
No, I can't. I couldn't stand it.
Right. Well, it'd be like if you had the ticker tape of each property value on the wall. Every morning you walk in, and as interest rates adjust, the property goes up or down, and it drives you crazy. Yeah, the stock market is not for everybody.
No, I would just die. I couldn't stand it. Yeah, I actually exited most of my holdings out of the stock market, although I'm thinking about maybe placing some bets.
Yeah, things are on sale.
Yeah. But again, it's like, I'm always, how do I build cash flow? What are the tax benefits? I don't get that.
Right.
In the stock market.
No, you don't get that.
It seems so like, it's like you talk to, I'm not trying to dub back on the stock market. We have a guy that says there's left field is real estate, right field is stocks, center fielder. He always says he's a center field ad nauseum. He says that, and which makes sense, but I also don't understand. It feels like Vegas to me. Putting it all on black or something.
Yeah, I think you're buying small pieces of companies, but it's very liquid. So therefore, it can move very quickly. And it's, I think the equilibrium, ideally it's based on the value of the company. The market moves up and down, whether it's higher than the equilibrium based on like greed or lower than sort of the value of the company based on fear. And so I think where there's opportunity, and this has to do with real estate too, because they're all connected in some way, or cousins maybe, is that when people irrationally sell due to fear, then things become undervalued. When they irrationally buy via greed, they become overvalued. And so I think it's our job, whether it's stocks or real estate, to understand that there's a couple things happening. Either things are going to trade at a value that is fair in a market, and that's usually in a market that's not controlled by fear or greed, or they're going to trade at a discount or above their value based on greed. So fear and greed can actually be opportunity. Here's another example. We sold a property, a couple years ago, maybe 2 or 3 years ago, our park in Washington. We sold it into a market that was a very greedy market, taking advantage of an over value price.
Compressed cap rates.
Right. So selling into a green market is a really good thing. Buying into a fearful market can be a good thing as long as you're getting under that value. The stock market is just a very fast version of all of this, making it look like a casino.
I was fast and say irrational, and it's so spazzy. I think that's it's like I just feel like this drunk guy just jerking the wheel all over the road, and every once in a while smashes into a tree.
Well, years ago I read a book, Benjamin Graham, The Intelligent Investor.
Yeah.
And he talks about, I think he calls it Mr. Market.
You can read?
And I can, but I didn't finish
I didn't know that
because it's a lot. So
not enough pictures.
So you're right. So anyway, he talks about Mr. Market, and he describes him as, and again, it's been a long time since I read the book.
Or he gives him a personality.
Right. And it's like a drunk guy. He wakes up every morning and he's just hammered. He's just like, that price is this, and this is that, and blah, blah. And it makes no sense, but for people that are value investors, in other words, buying below value, it can be opportunity. And the same thing is with the real estate market.
We will tie this back to real estate.
Yeah, because it matters. They're cousins. It's a leading indicator of what the market feels. If you think about the stock market and you look at just like an index, I think like SPY or whatever, it can give you a decent reflection of what the investor sentiment is. And right now, this date, investor sentiment is scared.
Well, I mean, it was like up 1,000 points, down 1,000. I'm just like, I was just looking.
It's a whipsaw.
I also, was that like was that 1,400 points this morning? Now it's up 200 and might dip negative by the end of it. It's like,
I don't know. Yeah.
The drunk guy is hammered.
He's hammered.
He's way more hammered than normal.
Yeah, I see he's wandering the streets. He just had a hot dog out at that bar. He's about to throw up a little bit. See the steak, sits in pants. He's going to throw up. He's not feeling great. But you see, Yeah. Well, so, I asked somebody in an Uber, I don't know, let's go.
Yeah. So I think about the stock market as the short-term fluctuations are emotions.
Yeah.
The long-term trends are based on fundamentals. Like you look at a stock, Apple's kicking its ass kicked because of the tariff things, because they import a lot of their raw materials or their parts from China, not raw materials. But I see there's, NVIDIA, and I'm not a stock guy, but there's some companies that have good fundamentals, tons of cash on the balance sheets, good income statements, good strategies, good leadership teams, but they're taking a beating on the stock market because it's emotional, but those would be the ones that you'd want to buy. Or like okay.
I think so. I'm not a stock professional.
And we're giving no advice. But fundamentally, you don't know what the hell we're talking about when it comes to stocks.
But it's no different than if you're looking at a mobile home park, an RV park or whatever. Every single day you look at it and you're like, it's for sale for $4 million. You wake up, it's for sale for 3.8. You wake up, it's for sale for 6 million. You wake up, all of a sudden, it's for sale for 2.2 million. And then you go,
But the fundamentals stay the same.
All the operations stay the same. The bottom line stays the same. Now,
but that doesn't happen in real estate because it's more rational.
Well, more rational. Usually, it's not a perfect market, but it's a slower market. To transact and buy a park or apartment building or whatever takes 30, 60 days of DD and then another 30 days. This takes a click of a button. So the liquidity is so high.
Sure.
It's so fast.
Yeah.
Anyway.
Yeah, I look at real estate too, though. You can, just to kind of parlay this into real estate. What I like about real estate, and I think this is where people that can do really well in real estate, we've done well, is you can exploit inefficiencies in the market. Whereas
it's imperfect.
The stock market, it's like a commodity. It's like buying soybeans or whatever. Like the price is the price based on the supply and demand at that time, because like you said, with the click of a button, you can sell
very fast.
Yeah. Where with real estate, you can look at a property. In fact, we're looking at one right now in Texas where it's an estate. Parents built the park several decades ago. The kids don't want to deal with it. We're looking at this park going, wow, like market rents are $400 in the area and they're at $180. They just, oh, wow, that's interesting. And there's an opportunity to go in and add a lot of value, pave roads, clean it up, make it nice, and get a hefty, handsome lift on the rents over time. Obviously, we do it responsibly and ethically.
Yeah.
But either way, you're adding millions of dollars in equity. And that's because there's inefficiencies and it was an off-market deal.
Right.
And the broker gave it, handed it to us to look at. And I don't know if we're going to buy that. Hopefully, we'll get into contract on that one probably today or tomorrow. But also, I think this ties back into what's happening today with emotions and real estate. I think the question that everybody's asking is, are there deals? We get in on our lead mastermind and we get people that are frustrated because, and it's true, like we closed 3 parks last year, good deals, but that was the first after a year and a half we bought anything.
Yeah.
because it was just sort of like this drought on deals. Sellers still had the voices in their head from brokers telling them that their properties were worth 5 caps.
Yep.
And the run up of the market, and it's taken them a while to come back down to earth. We found some deals, but now we're seeing more deals. And again, it's tied to emotions because people might be feeling poor.
Yep.
When you're, people are like, why would anybody sell this amazing park or this apartment complex? And why would they sell it at a discount? One reason they would sell it at a discount, this I'd encourage our listeners to think about, is usually people that own apartment complexes or self-storage facilities, or the asset classes we like, mobile home parks, they usually own other assets like that, and or they own businesses. They have other dealings like we have that. And if one business or another property is sucking wind and it's hurting,
It's all connected. Yep.
then they want to get liquid fast.
It could be a perfectly good asset, but a business is failing.
Right. Something else that you don't know
Taking
about.
a hit, and they're like, look, I'm nervous now that real estate will go down. I want to make sure I secure my retirement. I'm going to sell that, even though it's a perfectly good asset at a discount. Yeah. It's like, it'll be connected.
Yeah. And we also say like deals are made, not found. We say that a lot. And I would say of all the deals that we've closed on and have had success, the bulk of them are made. It's like clay. You start like,
They're made, yeah.
yeah, like that park we closed last year. The seller says, I want this price.
Yeah.
I don't want to carry a contract. I don't want to carry a note. And it is what it is.
Right.
And Mitch, being the soul-sucking greasy wheel that you are, slowly I would say beat her down.
It's a slow conversation. You think about like when the requests are big and the relationship is low, the answer is almost always no.
Yeah.
But as the requests start to be spaced out and the relationship builds, then you can hit a spot where the answer starts to be yes. And we're working on an RV park right now. It's for sale for $5.3 million. And then they wanted to sell the house for another 600, 700. Anyway, $5.9 million for the whole package.
Yeah.
I'm working with them right now, and they're like, no way, we're not selling them both separate. I finally got them to separate. That's one step. The next step is I'm not going to pay $5.3.
And they say, we're not interested. And you say, okay, this is how Mitch works. Okay, I understand. And then literally the next call, you're like, yeah, hey, how about separating that house?
And then I just go silent for a couple of days too. But also in the negotiation, we've talked about it before, the person who cares the less about getting the deal done is the person in charge.
Right.
Always. For example, they came back to me, they said, there's no way we're separating the house. We're not coming down in price. I said, okay, that's great.
Great.
I think we'll keep looking. Really nice, but just we'll keep looking. Well, they're like, oh shoot, there's a bird in hand. And the husband and wife start to talk, they get stressed and they start going, maybe we need to talk with this guy. So they come back and they go, oh, we'll take the house out. Then they take the price from 5.3 down to 4.8. Then they're like, we're not going to do a good interest rate. We want 7, 8%, whatever. Well, then we work on that. So but the negotiation is not done either. In contract, we'll find other things. We'll slowly massage them as we get further and further in contract. We don't want to retrade, but maybe if it's bad enough. So I think that negotiation it's an ongoing thing. It's not a one-time thing. When your requests are high and your relationship's low, then you have a gap. And that gap, that's where the no lies. But as the relationship builds and you're building a true relationship with this person, and then you're slowly requesting similar things, then I think you can reach a yes. It's interesting in negotiation because a lot of people think price.
Yeah.
But also think terms. So for example, we're working on this RV park. We get in a contract, say in 15 days from now, we find some things we don't like about the financials. Well, one of the things to think about is like the seller's really stuck on price. They don't want to come off the 4.8 now. We can come off the interest rate, or we can push the period from 8 years to 10 years, or we can. So anyway, negotiation is interesting. And I think it happens. People think that it happens at one moment in time, but I think that it can happen multiple times in the contract. That it doesn't need to be a retrade on price. It could be terms. It could be time for them to close. It could be what personal property you're including. There's a lot of things there.
Well, I think people look at negotiation as very transactional, and I know that you're really good at. I say the water torture thing, but you're really good at building rapport with people over time. And I love that because we say deals are made, not found. And I would say that's almost 100% true.
I would say too. I mean, well, yeah, you think about it, like I don't know if there's any parks we've really paid what they've asked.
Or if we have, they've come our way considerably in other areas. And that's the thing. There's other levers. So in the deal, all the levers in the deal, price is obviously important. And then if you get a seller to carry a note, which both these deals currently that we're looking at, we have that, which is fantastic. That's when things get interesting. You got interest rate, you got amortization. You can do interest only IO periods. IO periods. You can do down payments. There's a good buddy of ours, Ivan, who I think we're going to have him on the elite call, our elite mastermind after this to talk. You're going to have him as a guest. He's a good example. He's an awesome dude. He's 22 years old. He owns multiple properties now, owns a commercial building, but he's looking at this property that's a laundromat and has like an apartment that the manager lives in.
Right.
And it has this already approved 15-pad RV park. It hasn't been built yet, the RV park, but it's already been approved. And there's an RV park right next door that's a literally full 100% long-term. It's actually an interesting deal. And you were talking about, this is a great example, and we sort of mentor Ivan. This is a great example of the seller just hell-bent on price and down payment on the seller note. And I was talking to Ivan. I'm like, yeah, man, you're paying because it's the in-place NOI. It's a laundromat. I'm like, you're kind of overpaying for this deal a little bit. And he's like, but the seller's just set on price. And so I'm like, they will carry a note. He's set on price, a down payment, and a monthly income. And so okay, well, what if you were to give him the price? What if you were to give him the down payment, but for 24 to 36 months, that payment is a principal only payment.
Right.
So that you're not paying any interest, which is it's just a significant expense of the deal.
It's huge.
It's just interest that goes to the seller. It's income to the seller. It's an expense to you. And so I'm like, at the end of 24 to 36 months, you'll have paid down the principal note considerably and then start amortizing from there, but amortize at the new loan.
That's a lesser amount. Yeah.
Yeah. And so
the seller gets what he wants, and Ivan does too.
Yeah. And when you look at like the overall, like the equity multiples on that deal, the internal rate of return and other things, it actually brings it into alignment and makes it a pretty good deal.
It's interesting because a seller usually has a primary goal or a couple primary goals, and then they have secondary goals. So like the primary on this park we're looking at is, I would say...
you want the RV park or the mobile home park that we're looking at?
The RV park.
Yeah.
Well, it's interesting because we've adjusted most of their primary goals as well on this RV park. So it's hard to say, we've got them down on everything. But most of the time, the seller's going to be stuck on something. So they're like, look, I want this price. Or no, I want this down payment because I got to pay off this debt. I've got to... So in fact, actually, this one is a good example. They need a lot down because they have to pay off debt.
Right.
So that is one thing that we can't move on, but we can move on the other things. So I think identifying what are the primary goals, and the best way to identify that is to ask.
I know. What's your get that? I don't know.
Like ask what do you want? So
what's the definition of a good deal for you?
Right.
So what's a good outcome?
And they'll usually talk about it, and then there's going to be a couple other variables, whether it's interest rates or terms or IO periods or whatever that is, that you can say, hey, can we give the seller the primary goal or very close to it and then adjust these other ones to make the entire picture make sense? I think that's, I don't know, negotiation 101.
Well, look, so let's talk about this. Where are you finding these deals? I could tell you from this deal that Ivan's talking about was MLS. I think it's a broker that doesn't really understand. You see that a lot. You see residential brokers that are trying to sell. I mean, this is a more complicated asset. It's a laundromat, which is a business. Right? There's an apartment, and then I think there's some storage capabilities and RV.
Yeah.
So there's a lot of stuff on market. This deal, this RV park was on market too, right? Again.
Yeah, it's on market.
And we see a lot of people, and even in our elites, they're like, I flip through Crexy, I find a price, I don't like it, I move on. Well, again, that doesn't mean anything.
It's short-sighted.
Right. Just because someone's asking a price doesn't mean anything. And so you thought it was interesting. You like the dynamics. We are mobile home park investors. We have one destination overnight stay RV park, a hotel, and some other assets. But we understand our best asset is a nightly stay RV park.
Technically, our highest cash flow asset. It's a unique situation because we're the only sort of game in town. So
right. We're in a resort town. We don't have any competition.
Park, yeah.
There's levers you can pull in these nightless stay RV parks where you can go in. There's a lot of mom and pops. They keep the rates the same year round or similar. They're not doing dynamic pricing like the airline model. They're not doing like what we call site lock fees. So we actually bought this park, we renamed it, we rebranded it. This is the one we have here. It implemented software. It was a tech play.
It's a tech play.
And increased the value. We bought it for $2.2 million. It's probably worth well over $4.5 million now. And that was just implementing dynamic pricing, better marketing. We went from a bunch of staff to one person because all of the bookings happen online using AI and other tools.
Like employees.
Yeah, the tech. I love how you always say, always look at tech before you hire somebody, this is a perfect play. You found this park, you looked at the price and you're like, but you're like, I like the area. I like that it's a destination park. It's like it's not a roadside park on your way somewhere. Like this is a park people are going to get. It's on a river. It's beautiful. It's got pool, clubhouses, all this stuff. And so you dug in, you looked at the price and you're like, that's cute. But you dug in because you understand the value add play on these parks. And so you dug in to see if there was an opportunity for that. Like, what was your mindset what's the thought process from the minute you saw that listed, like this park was listed on, what was it, rvparkstore.com?
Yeah, it's on RV Park.
Yeah, rvparkstore.com. The whole world sees it.
Yeah.
But, right, if the whole world knew the price that we had right now and the terms that we have, the whole world would be way more interested. But the whole world passed on it because they saw the price and moved on.
Because they don't, yeah.
Yeah, so what was your thought process? You saw it, you saw the price, and you're like, interesting, I'm going to go in further on this.
Yeah, I think that like, when it comes to parks, at least, any asset, you're looking for opportunity. For me and for us, I think we look for opportunity for upside. We're not a big hedge fund that has to deploy, or a big private equity group that has to deploy hundreds of millions of dollars and just preserve it and let it grow slowly over time. We're a small boutique investment company. So naturally we want upside, and upside means increase in or growth in revenue, decrease in costs, one or both of those two things. So initially for me, I look at the price, I give it a little bit of credit, but it's like, I want to know, is there any upside into this park? Can I adjust things? Can I make adjustments to this park to make it better? So I'm seeing that right away. I know that there's value there. There's opportunity to add value.
Right.
So for me, the next step is, hey, why don't you reach out to the broker and just get an idea of financials? Based on the financials, which we're still digging into that, what I'm next trying to understand is what price and what terms would be attractive, not just to me or us, but to investors, to capital providers.
Yeah.
That's a very first.
Always got to think through the lens of an investor.
Right. Because I'm not going to go in with a couple $1,000,000, neither are you. But if I can create an advantageous situation for capital providers, then we can attract it. So that's the second thought. And then basing the offer and terms, the price and terms off of that. And so the next thing was like, look, if I can come in at say 4.8 and I can build in decent seller terms, we're going to be raising a lot of money. If we gave investors a preferred return of say 7%, that would actually make sense for both sides. So now I'm looking at going, look, what works for Cadia, our group, as well as capital providers, and can we marry all these up into, is it worth sort of going into PSA and going further down the road? And then of course, and by the way, these are based on, I'm looking at a pro forma, I'm looking at some rent rolls. I don't have occupancy numbers yet. We're swagging the upside. Yeah, I'm going, look, May, June, July, August, September, those are our busy months. If those are 50% occupied, I can increase by maybe $20. So we're running these like basic models, but it's enough to get into contract. And then of course we have a lot more to do.
Yeah. I mean, just to finish the conversation on this RV park, we were just in this office because again, Mitch comes and loiters at my house all the time. We were in this office trying to figure out, do we get into contract?
Yeah.
And because it was interesting, last week, she's like, okay, fine. The sellers are willing to come down to 4.8 million.
Yeah.
So one of the I'm just looking at our whiteboard here. One of the quick exercises we did, like Mitch is all, we haven't even put this into an advanced pro forma tool yet. We're just like looking at this going, does this make sense? What's the current NOI? Does the current net operating income make sense based on their financials? Does that expense, and we actually, I think the expense ratio is a little low, what they're marketing. Yeah. So we pump up the expense ratio and we match that with the RV park that we have here because there's a lot of similarities. And like even at that expense ratio, we were like, okay, this NOI actually looks interesting. We could actually give investors 7% pref. We can do all right with that because I think it's got a global like 10 or 11% cash on cash sort of going in.
50-50 after that. Yeah.
So we're like, okay, that works. That could work. Worst case scenario, we're coming in with a lot of cash. I like it because our debt hurdle is really low. Or really high, I should say. Yeah. It's like a 2.4, which gives you a lot of cushion and it preserves your capital. It de-risks the deal significantly. A lot of people don't understand that DSC, our debt service coverage ratio, is not just a bank thing. You should be looking at that too.
No, it's a safety margin.
Right. It's a buffer. But then we looked at it and we're like, yes, these rates are pretty low. It's year round. What if we took these busy months and we raised rates by, I think we're looking at this like $15 a night. And what if we were still at 50% occupied in the busy months? Interestingly enough, the global cash on cash goes up considerably. That brings our investors' cash on cash north of 10%.
Yeah.
We're doing really well. We're having a good time. This thing's working. And then we get in and we start looking at the park and we look at their bookings rates through like June, July, weekdays, weekends, May. We're like kind of just spot. And we're also checking some of the competing parks in the area. And we're like, I think 50% is really, really conservative. Like these things are booked. This is probably like 80 to 90% in the busy months. So we're like, okay, well, let's bump it up to 60% occupied.
Exactly. And so the other thing too, when you think going back to dynamic pricing, when you think about dynamic pricing, we're running a very rough model here. We're going, look, let's just do 15 or 20 bucks a night across these nights. But in reality,
and being conservative.
Exactly. Yeah. Because we want to be conservative going in. But in reality, say we were to buy this park, just like our local park, dynamic pricing really should adjust with demand for the site. And the demand for one site throughout the year, depending on the month and the day, changes drastically. And there's no way to, maybe you could chart it out, but if you just think about this philosophically, one pad in the middle of December is value and demand is very low, not that high at all. But now think about Wednesday in July. It's pretty high. But now think about a Friday or a Saturday in July. It's at its all-time high.
Tons of demand, very little supply, or no supply hardly.
No supply, massive demand. So your prices should reflect that. So in the middle of December, your price is going to reflect that low demand. On a Thursday or Wednesday in July, it's going to be a lot higher. But on a Friday or Saturday, it should be even higher because people are going to pay. That is the most valuable night possible. And the first thing we do, just like the local park we go, look, it's a fixed rate. The whole year's fixed rate, no matter what night.
Just buy the thing because there's so much value add right there. Yeah.
Yeah. And I think that, like you said, the airline industry does the same thing because they understand that demand changes. You have a product, the product stays the same. The demand cycle changes depending on the day or the month.
Right. Yeah. And I think in this technology, inexpensive SaaS-based technology that implements all that. Yeah. It builds the algorithms. Okay. So we're talking to RV parks. We always love mobile home parks. RV park. Okay, let's talk about RV parks really fast. Because we might be staring down a recession. I think some economists are predicting a 40, not to freak people out.
Yeah.
Okay, but that's something you got to think about. What are the market cycles? We're looking at potentially a contraction with the tariffs in place. What asset classes do we like looking into a recession? Okay, we looked at RV parks. Actually, ChatGPT did. Because we haven't owned a nightly stay RV park in a downturn.
Technically, COVID was a slight downturn.
No,
but it's strange.
I love when you're like, that was our recession year, or that was.
No, it was a strange time in history. But we have been reading about RV parks, which is interesting. There's a lot of information alluding to their recession-resistant. Mm-hmm. They do all right because people cut out the cruises, they cut out the international travel, or even the national travel. Right. Go local.
Like you were going to go on a cruise, and you're like, let me just take the family in an RV which is amazing.
Right. So I think people suck in, they go more local RV. The other thing too is things really went south. You still have a lot of pads and there's still demand for housing. So I think, when we looked at Gorge Base Camp, for example, I remember looking at that going, well, gosh, like if travel just froze up, could we just rent them out to people who want to live here? Mm-hmm. And that's sort of,
and we do, we have sort of names well
in the wintertime.
Yeah. Right. Yeah. Okay. So let's talk about other asset classes. So our thesis that RV parks, like people will move from the London trip and they'll go to traveling in an RV or the international flight, like you said. Let's talk about other asset classes that we like or dislike going into a recession. How do you feel about mobile home parks, which is the bulk of what we own? How do we like mobile home parks during recessions?
I think that I would argue that it's of all real estate assets or classes, I think it's probably the most resistant.
Because it's the most affordable housing asset.
Well, you think about it, and here, this is an unfortunate truth, is during good times, people get left out. And during bad times, the line grows. And so you have an asset that anywhere in the cycle, the line continues to grow. We have a country that when times are good or when inflation is in check, it's like 2 to 3%. What does that mean? There's a growth in prices. Life's getting more expensive.
Right.
On purpose.
And wages aren't keeping up.
Right. They don't. And so unfortunately, we have this country where the way it works is life gets more expensive. That's their goal. Mm. That's the goal. So to me, in bad times, the line grows, and in good times, the line grows for mobile home parks. And by the way, that's not just like an opinion. When you look at like Fannie Freddie agency debt, it's like the lowest default rate of all asset classes. Right. Is mobile home parks.
Well, mobile home parks specifically that have tenant-owned homes.
Yeah.
We don't like to own parks where we own the homes themselves.
Yeah.
And I agree. I'm a big fan of mobile home parks, obviously.
Yeah.
I think we've had a lot of success in mobile home parks, and I think originally it was my idea. You wanted to buy apartments, and I said mobile home parks. But we're not here to are we not taking all the credit? No, but yes, I think mobile home parks are interesting because it's a neighborhood. And we go and we'll pave roads. We'll help people fix up their homes. We'll clean up junk. We'll put playground. Like we add amenities. We make these nice little neighborhoods. And like pad rents, the average pad rent across the country is like what, $350?
Yeah. I mean, when you're half of the next 2-bedroom apartment, that's a low end 2-bedroom apartment, and you get your own home.
You're not a box in a box. You get a backyard. Yeah. No, so we like that. And I do agree that I do not worry about our mobile home parks. Look, no, I don't. Yeah.
I don't either.
What about, let's now continuing the topic of assets classes, multifamily. Okay, so multifamily has been a bit of a 4-letter word for me because as I've told people, I was a passive investor in some multifamily investments. I had to take them over. These are like affordable housing type multifamily assets. We put a lot of money in these complexes in Oklahoma City. I'm 95% occupied. I think it's going to turn around. I would think this month or next month, I'm going to take a distribution, which is like, hallelujah. I guess that my question though is multifamily was the darling. There's a lot of people that made some, and we'll get into some of the syndicators, some of these people that were buying multifamily as fast as they could, paying whatever, and we're paying attention to future rates. But multifamily got a bad name. There's a lot of multifamily assets that might be in trouble right now. How do you feel about multifamily looking in the future, looking at these potential tariffs, recession? How do you feel about multifamily as it pertains to the run-up? Like, what's your thoughts on multifamily? Because there's a lot of multifamily in this country.
I'll preface it. I'm not a multifamily guy. I'm mostly focused on RV parks and mobile home parks. So I want to say that to listeners because my opinion is maybe average at best. Right. But I think that when you look at multifamily housing, you have to really pay attention to the supply and demand curve. There's a lot more supply coming online versus like when you compare it to mobile home parks, for example, they're not issuing permits for new mobile home parks. You have basically a fixed or decreasing supply. There's like 44,000 parks in the country, and it's actually disappearing by 1% per year. You actually have a supply that's going down with a demand that's going up. When you look at multifamily housing,
but don't buy mobile home parks.
Yeah, don't buy them.
Don't buy them. Go to another asset class.
So the deal's asked. But when you look at multifamily, depending on where you are in the cycle, you have hundreds of permits pulled in any one geography.
Austin or thousands. There's certain cities that went bananas.
So you have to be careful about supply and demand. And one of the things in Dave Lindahl's, I think it was Emerging Markets, he talks about watch out for cranes, right? When you look across the city and you see a ton of cranes,
run.
Because there's a lot of new supply, not yet done, but about to hit the market. And can that market absorb that new supply? And so over time, over the long run, I think that multifamily housing as a large asset class is probably fine and healthy and it has room to grow. But like you have to pay attention more to the supply of multifamily than even RV parks or mobile home parks. I also think that when you look at multifamily P&L, and we saw this during the last run up in inflation, the P&L is made up of a lot of expenses. There's turns, there's maintenance, there's labor, there's insurance, there's rent. I'm not right. So you know this better than I do. Well, the larger the P&L, the more it's susceptible to manipulation via
more expense line items on the P&L.
That's right.
Like our mobile home park, is like we have like 5 expense line items.
Right. So now you have this apartment complex that's experiencing high inflation, and the top line rent, you're going, hey, we got to increase rent really fast because our expenses are going up. Well, can you do that? Will the market bear that? Or are the expenses going up so fast that it's going to eat you? It's going to eat the profits.
Right.
So I think that's a risk. When you talk about tariffs, and we don't know how long this will go. Is this a negotiation tactic? Is it a short-term thing? Is it a long-term thing? We have no idea. And I don't want to try to predict it. But when you look at tariffs, the importer pays the tariff tax to the U.S. government when it hits customs. Okay. So if I'm ordering lumber from Canada, the day it hits customs, I have to go pay the U.S. government that tariff. It's not charged to the other country. It's the U.S. company on import tariff. So the challenge with that now is I have a new cost associated with that raw material. That raw material now goes into an apartment turn, and who do you think I'm going to pass the buck to? The apartment owner. So again, we could experience an increase in prices with apartment owners to service the apartments. Just like we saw in a high inflationary environment.
Fixtures, towel, all of it, bars,
everything comes from another country. And it's not Canada or China or whoever that pays that tariff. And that's where people get confused. They go, oh, well, let's go punish China. Now, inadvertently, it can punish the countries because now we buy less from them. We buy more locally. But in the end, that vendor or that importer pays that and then passes it to the customer. So we could see inflationary pressures due to tariffs as well. And when you talk about apartments, going back to apartments, you have a lot of expenses, and those expenses could be inflated faster than rents.
Yeah, I mean, just to dovetail on apartments, it's funny. I wish we had JT here, our buddy from Coast, who's been running my complexes. And
yeah, he's a whiz. Yeah.
Okay, so going back really fast, pros and cons of apartments, looking at a recession. There are some markets that had an oversupply. Austin, I mean, there's people getting their asses handed to them in Texas.
Spin back properties.
Yeah, Memphis, Texas. There's some of these more hotter, sort of bubbly markets where they were building a lot of apartments. And they were building a lot of apartments with the expectation that expenses were going to stay at X and that rent growth was going to be at Y. I can build this nice A-class apartment and I'm going to be able to get a premium rent. Well, they're finding they weren't able to do that because of, again, more supply.
And maybe it's true. Like if you were the only new apartment in town, maybe you would achieve those goals. But when you have cranes across the city and you all hit the market near the same time, now there's a new problem.
And that is like, but there's some markets that there was no construction. And I'll get into that in a second. Like Oklahoma City, luckily, wasn't one of those markets. So you have an oversupply in some of these markets. These apartment owners have to start lowering their rents to get people in, because even if you have rent that's at 80% of what you were hoping it would be, that's better than zero, right? Yeah. So but to compound the issues on this, to your point, the cost of construction's gone up. It's gone way up with inflation. Forget tariffs. Like this has been an issue.
Right.
The cost of insurance in some markets has 4x'd. With weather issues. I've experienced that in Oklahoma City because you have wind and hail, but like it's been one of the worst insurance markets in the history of the insurance markets. So insurance has gone up, property taxes have gone up because these municipalities are like, oh yeah, remember, like these things are at 5 caps, 6 caps. And so it's really put up, and then it's put a hurt on these apartment builders or apartment owners. But the positive on apartment there's a few positives. One, there are people that want to offload these complexes, and they might be selling them at a loss. We're noticing that banks aren't willing to take these properties back like they were in the housing crisis. Banks don't want to own real estate. So they are starting to work with these operators. They're adjusting their rates down. They're trying to make it more palatable for these investors or these apartment syndicators. Let's talk about syndicators. I'm hearing more and more people that were raising a lot of capital, buying a lot of property, a lot of stuff in Texas, variable rate debt, thought the party was going to go on forever. I'm seeing it. We're hearing of distributions getting paused. We're hearing of syndicators going under, not just in apartments though. We're seeing issues in other parts, other asset classes. What are your thoughts on that? How is this multifamily thing going to play out? Or are the banks going to own all these properties and people are going to get pennies on the dollar? Are people going to hold these properties? The banks are going to work with them. Are there going to be more multifamily opportunities? The other thing too is, although there was a lot of oversupply, because people can't buy houses, because the cost of homeownership,
the cost of building way. So a lot of people didn't build. Well, it depends on the market.
Building was behind from 2008. Yeah. And now with inflation, it's like they're saying it'll never catch up. And then you take that with new home, especially new home builds, you take that and you couple it with the fact that people can't afford houses anymore. The prices of houses are too high, rates are high, so people have to rent. So what's your thesis on apartment complexes? A class, B class, C class? Would you avoid it like the plague? Would you be opportunistic? Do you think there's going to be deals? Like, what do you predict on this? Like JT, they have several thousand apartment units.
Well, don't tell me yet what he predicts, because then I'll be biased.
Okay, what's your prediction?
I want to hear what he says afterwards. But I think that when you look at apartment complexes, you need to really understand the market you're in and understand way more than mobile home parks or RV parks, the world that we're in. You need to understand what supply has hit the market, what's absorbed.
The local geography.
Yeah. So if you have a market like in Austin, where you've seen cranes in the sky for months and months and months, and now you've got oversupply, absorption rates are low, they're leasing them up, free for 1 month or whatever that is. Well, that's different than an area that has not seen building. It has not seen speculative growth, but has people moving into the area. So I think it's hyper local. I do think that there are a lot of areas like that where builders did not build because prices were too high. And the bench for housing is growing. There's more people coming in the market and they need housing. I think overall apartments, paired with people struggling and there's opportunities to buy, or potentially assume Fannie Freddie debt.
Good debt.
Agency debt. I think overall, I'm bullish on apartments depending on the area. And the biggest reason for that, I think, is the struggling apartment owners who paid too much, paired with the fact that a lot of builders went home and supply fell off in multiple markets. Not all markets. The markets where supply came on very, very quickly and a massive amount of permits were pulled, that's where you're going to see the oversupply of the problem. That's the Austins of the world. But other markets, I think you could see, like Minneapolis area is one where you're like, okay, we have good absorption, we have good demand, and we haven't seen a massive amount of building. That could be healthy. So I think it depends on the market, but overall, I'm bullish.
So what you're saying is real estate's based on location. Was that new? Is that a new concept? Sure. No,
I mean,
or she did.
But what does JT say? Because JT is in the apartment world a lot smarter than I am about this.
Yeah, was a lot smarter than you on a lot of things.
That's true.
Yeah,
I'll give it to him.
Just in general, JT's bullish. Obviously, he's bullish. He's an apartment guy, but he's also very pragmatic. He came from the consulting world. He's, I think, it's a CPA by trade. Even the markets that have been overbuilt, he sees. Right now, there's many markets across the country that are underbuilt. And so rents are, and I'm seeing that in Oklahoma City. My rents are rising because they didn't build at all. Even the markets that like Austin, where they did, because Austin's sort of like the bastard right now, right? We like to pick on Austin. Even markets that are overbuilt, within a year or two, they're going to be underbuilt. Yeah, they're going to absorb because, like you said, there's more renters entering the market. They can't buy houses. People are living longer. People are also sitting in these homes. They're not selling their houses because they're sitting on this 2% interest rate or this 3% interest rates. So he believes that quickly the demand curve is going to shift in apartment owners' favor. And so that's also, that's a reason. Now,
hold them long enough in those markets, then you'll absorb.
I don't know how we handle the expense side of the apartments. Insurance is out of control.
Eventually, unfortunately, the expenses will be passed to the tenants. It's just how fast can you go?
Well, if wages aren't keeping up and there's only so much a tenant can pay on housing, where do we head? Where do we go from here?
Yeah, well, I mean, the ultimate drivers, we need to get inflation in check, which it is. And last I checked, it's 2.8 or so. But if we have 9 or 10% inflation, your entire equation's skewed.
Everything's skewed. But it's not just, it's everything. Yeah. Well, so, okay, let's talk interest rates. What is your prediction on rates? Rates has been the top. I mean, real estate investors have been getting their teeth kicked in with rates. Like, we love owner contracts because we're able to get around these rates. I bought my first house at 8.5%, by the way, in 2000.
Yeah.
Because I'm a baby boomer, according to you, which I'm not a baby boomer.
Well,
right, yeah.
It's debatable.
Yeah. So it's not debatable, actually. It's math. So interest rates, where do we, if Gabe was on right now, he would say, I buy in all interest rate environments, which I do agree. So are we. Yeah. But like, where do you see interest rates going right now? Do you see rates coming back down? Do you see, because it's funny because the Fed did make some moves and it didn't do much to interest rates. I mean, a little bit. We see interest rates tied to the treasuries usually. And I'm not an economist. I'm not a wizard on this, but we are seeing, like, we're refinancing a property right now where interest rates are tied to the 5-year treasury plus a spread, or we see quotes from banks where it's like the SOFR, the overnight rate tied to the spread, or prime or things like that. So where do you see rates going?
My first prediction is that my prediction is going to be wrong.
Yes, you're wrong, probably.
I don't think that I can predict anything, but I think that there's multiple variables, and this is maybe the hardest day in the last couple of years to predict rates, considering the recent tariffs on I don't know how long those ago. But when you look at interest rates, they are primarily a lever that's used to control inflation, to keep it in check, to slow it down.
It's the overnight rate is.
To speed it up.
Yeah.
But as they adjust, so when you look at inflation right now, I think it's at 2.8 or late 2s. They want it in the lower 2s. So for now, I don't think there'll be a rate adjustment
on the Fed.
Unless there's I'm talking about Fed.
Yeah, overnight rate.
So unless there's other factors or pressures and but the challenge that I see is that with tariffs, again, the importer pays the tariff. We have multiple companies right now that are coming into the office going, what in the hell are we going to do? So if they continually source from the same supplier, they have to pass the buck on to the consumer. And that means higher prices. And so we could see inflation driven by tariffs in the short term. And that, to me, would not lend to a decrease in rates.
It would be yeah, the feds would hold tight, longer for or higher for longer, right?
So I feel like the uncertainty and the tariffs could drive prices up, meaning that they hold. And then when it settles out, we see the stock market resurge potentially. If tariffs are short term, okay, like if they're long term, we will actually see damage to our economy.
Yeah.
Because companies cannot go. When you look at say 100% tariff to China and you have a company that sources product from China, what happens? In the short term, you can make it. But 6 months, 8 months, 12 months, now you're
Smoked.
Now you're going under, you're laying people off. So I think one of the big factors is like how long they leave the tariffs on, whether or not we see inflation or we see like unemployment.
It's an interesting paradigm. I do believe that if tariffs stay in place for a long time, at least at this level, and if it's this aggressive, there will be a contraction in the economy, which does affect your renters, by the way. If renters are unemployed,
if it affects the renters, it also, if we go that far and we get unemployment, then we see potentially, say the tariffs come back off, and now we see a decrease in inflation because people are now, they have less money, consumerism slows down, so then the interest rates could go down.
It's an absolute paradigm because there's all these sort of like contracting or contrasting variables. Like you said, okay, well, if the economy goes into a recession, if we contract, then the feds will need to use that lever. And I think they're keeping that lever in their back pocket for now. They're looking at it going,
well, they don't,
yeah.
They don't want to use it too soon either because like,
well, they're also, like you said, I think tariffs are going to drive inflation and then they're going to have to hold off on lowering rates, but then and this isn't a political conversation. This is just economic. Prolonged tariffs will then potentially contract the economy, at which point jobs, because the Fed has a dual mandate. It's jobs and it's inflation. So then jobs will reduce. So then they'll bring the rates down to sort of try to trigger the economy again.
I think you could easily, like, not political at all, just cause and effect.
Yeah, don't get into politics.
I think just cause and effect, you could easily conclude that tariffs could absolutely put us into a recession. When you have the price of imported goods going up 50 to 100% in some cases.
Some people are freaking out and they're using the D word. So they're saying this was the Taft tariff thing before the Great Depression.
It can absolutely drive you into a recession or depression, depending on how long they stay on. If it's short term, I think that maybe short term is a negotiation tool. And they come off and the stock market rages and it turns into a V like the COVID days, right? It's like, oh, I was freaking out. The next day,
the drunk guy slams into a tree.
He's still, maybe that's the case. But if they stay on for too long, and China doesn't look like they want to back down. Their last word was, we'll fight till
the end.
So
I saw that.
That sounds...
It's eerie.
Doesn't sound great. So that could be a major problem.
Yeah. And here's a real world paradigm with interest rates that I'm experiencing. Okay. So I have a building. I don't own this with you, Mitch. So sometimes I do stuff on my own. Everything doesn't have to be with you. So I own this cool historic building in my hometown, and I negotiated with a credit union when I refinanced it. I was like, look, rates are high. When rates come down, you need to work with me. You need to adjust this mortgage down. And she said, absolutely. Super cool girl, CCCU here in the Hood River area, Lisa Hobbs. She's great. Okay. So me being the dumbass that I am, the Fed, and I should know better than this. I should go back to my loan docs and see what's the rate based off of. Is it based off the overnight, which is SOFR? After, I think, what was it, like 50 or 75 basis points reduction? I email Lisa. I'm like, okay, Lisa, I'm ready to lower my rate now. And she goes, gosh, Travis, yeah, there's this weird paradigm. Even though the Feds have been lowering rates, the treasuries were still really high. The treasury yields were high. And so there's really not much we can do. I'm like, oh, crap. Okay. I don't think the Feds have done anything since then, but the treasuries have come down. Right. Over the last few weeks, they've come down a lot. I think 75 basis points. And I believe this mortgage is based off the 5-year. The refinance we're going to use based as a spread off the 5-year. I sent her another email, I think 2 days ago. I'm like, hey, Lisa, what do you think about adjusting those rates down? She goes, absolutely. This is the time to do it. And so she's working on it. Maybe she'll conveniently not get back to me anytime soon because she's making more money. But anyway, so again, rates are a weird thing.
I started the answer with saying that this is maybe the worst time to try to predict interest rates. Before tariffs, I would have said, I think we're going to see them come down because inflation was trending down. Right. It's gone a high of 9%, maybe late 8s to 2.8. So we've trended in the right direction. But now, are there inflationary pressures or are there not? And we don't know until this tariff thing starts to flush out. You think about companies in the very near future will be making their orders from their supplier at 100% or 30%, or depending where they're from, higher cost of goods sold. That's a problem by the company on import tax to the U.S. government. So government revenue is going to go up.
They're saying they're going to give it back to the American people in the form of tax breaks.
We'll see. I don't know. There's no way for me to predict the future. And I think it punishes local companies, U.S. companies. It also does punish the country that...
A trading partner, yeah.
Yeah, for sure. Because what also happens is a lot of times a trading partner will actually reduce costs to maintain that relationship on their end, therefore taking a piece of that tariff.
Yeah.
So if it's increased by 50%, they might say, hey, look, I want to maintain this relationship. We'll take a 25% hit.
Yeah.
That's an option, though. That's not a requirement. But sometimes you'll see the trading partner eat part of it.
What's your prediction on tariffs, Mitch? And I'm going to hold you to this. Is this prolonged? Is this a negotiating tactic? What is in Donald Trump's head when it comes to tariffs? What's your prediction?
I don't think any of us know what's in his head, first of all.
Yeah. What's your prediction?
I think that if it were me, it would be a short-term negotiating tool, but it would not be a long-term, because long-term, I think you could do not irreversible damage, but very much enough damage to shake the economy, to push us into depression. I don't think so. I guess if I were to say, I think it's a short-term negotiation tool, maybe 3 to 4 months, but like you go for 6 months to a year.
Yeah.
I think you have big problems.
I agree with you. I do believe that Donald Trump has a history of shock and awe to bring people to the negotiating table. And I think this is exactly what he's doing. Yeah. He's also not a dumbass. Some people would argue that he is. I'm not arguing one or the other. I'm just saying he's not a dumbass. He understands you've got midterms coming up. I think he's doing a lot of this stuff early on in his administration because he truly believes. I mean, he's been talking tariffs since the 80s. Like this guy has a conviction that the United States has been at a disadvantage in trade globally. And I think he's doing this early on because he truly believes that it's going to bring the world to the negotiating table. We're going to get better deals. He's going to be a hero. Yeah. It's going to secure the midterm elections. Because you're right, you can't go too much longer. Then the damage to the economy is going to cause massive political damage to him. So
I think no matter what, you're playing with fire.
It's a bet. It is Vegas for sure. Yeah,
and it's unprecedented how fast it's happened, how aggressive it's happened.
And he's also,
we'll see. And for me, I'm like, we'll see.
He's also testing the patience of the world, our trading partners, internationally. Like, is this?
Well,
yeah. Is this
testing relationships as well?
As I'm saying, yeah.
So the outcome will be interesting. It'll be interesting to see how it flushes out.
Yeah, more than interesting.
Yeah, it's a bit of chicken, right?
Yeah.
And if the other one gives, maybe you win. But if they don't give, maybe you lose.
It is chicken, which is a risk.
There's a risk involved.
If the other guy flinches, you look like a hero. If you flinch, you look like you failed. And or you just slam into each other and everybody dies.
So it's like you go to it's like I'm like, I'm going to go to Vegas. I'm going to put $100,000 on the blackjack table. And I'm like, is that a good idea? And you're like, I don't know. Probably not. Maybe. And then I win and I go, told you.
Yeah. But you're a genius.
There's an inherent risk to, and it's maybe not the best analogy, but like there's an inherent risk to this. And I think short term, it could be used as leverage. Long term, it could absolutely damage you as enemies.
Last thing, hold or sell? What's your thoughts on holding? Because we're always talking about buy and hold cash flow real estate. Yeah. We're always talking about that on it. Buy it, cash flow it, till the cows come home, hand it to your kids. Like, how do you feel about buy and hold right now? I know how you feel. I'm asking this rhetorically. Well, I know the answer.
First of all, don't hand it to your kids and don't hand it to your kids. Make them work for their money.
Yes, absolutely. That's great.
First one.
Yeah.
But I think that like our take on this has changed a little bit, obviously. And one of the things we're looking at is what's the speed of capital? What's the speed of money? How fast is it growing? And so before it was like buy and hold forever, which is fundamentally we want to be holders.
But you just said don't hold forever. Don't give it to your kids. By the way, don't give it to your kids.
But like buy and hold for 10, 20 years.
Guys, I'm joking.
So I still think buy and hold holds up, but I also think that there's some intelligence in analyzing your portfolio, understanding what assets have growth and what assets have no growth at all. And you can tap that equity for better uses. If you look at certain assets in our portfolio, they've experienced a growth curve and now they're at a plateau.
Yeah, there's not a ton of room for rent.
We increase rents like $8 next year.
Yeah.
And there's no more cost.
But we've already added $800,000 in equity.
Right. So now the question is, could you take that equity, relocate it into a new growth vehicle, do a new growth asset And that's what's
and renewed tax benefits,
right.
The new asset through cost segregation studies.
Exactly. I think that for me, it's 80% hold, 20% trim.
Be a net holder.
Somewhere there. Yeah.
Take your chips off the table, redeploy equity.
Yeah. We
had somebody on the podcast, and we had already been talking about this because we were like, let's just buy and hold everything forever. And we're like, okay.
Initially,
we've got 2 assets we're going to probably sell this year. And we're like, you buy 4, you sell 2 a year, you become a net holder. And that's really powerful, but you can redeploy that equity into faster growth vehicles. And there was somebody on this call that had the same epiphany sooner than us because we're a little slow. But he's like, I realized that I was cash poor all the time.
Yeah.
And I was real estate equity rich. And if you look at your cash and equity, it was abysmal. And so he learned to prune the tree every year, take wins, take big capital injections to his business. And he said that I grow my passive income faster that way because I can redeploy that equity into better assets and that have more room for growth. Also, too, like something that we're realizing, if you're going to be pruning the tree and selling some assets as you go along, leave room for the buyer.
Sure.
Leave some meat on the bone because for those of you meat eaters, that's an analogy. I don't know what the analogy is for my daughter's a vegetarian. So leave some corn on the cob. Anyway, yeah. So I don't know why I just went on and on about food. But anyway,
got on.
Yeah, all right. Yeah, it's weird. It's still weird. The buyers, though, we're noticing like, we've seen this for buyers, like there's just not enough upside for them. You're like, we thought we were optimizing these assets. The rents was at the peak. The expenses were at the lowest. It was very efficient. Yeah. And you do got to leave some upside for the next person that's going to go, oh, I have, maybe it's a $25, $30 rent bump. I can get some quick wins. Wow. What a great podcast. I had fun. That was long.
That was a lot of fun.
That was long. And
no, we covered a lot of stuff. And we're in a time in history that I'll leave with this. My grandpa was 95 when he died. This was a couple months ago. Sad, but also an amazing life.
Right. Sorry about your loss.
No, it's okay. Well, I was sitting with him a couple months back, maybe 6 months back. And he goes, Mitch, because I was talking about all these things. And he goes, slow down, relax. He goes, grab a bag of popcorn. And I'm like, what do you mean? And he's like, sit back, enjoy the show. And he's like, I was born in 1929, right? Into the Great Depression. His childhood was the Great Depression.
Right.
He joked that everyone got depressed when he was born.
So does he say that? Oh, yeah, awesome.
Yeah, and he goes, it lasted for like 10 years, and then World War II, right? So he was 11 years old or 12 years old, somewhere in there. I might not be doing the math right when Pearl Harbor was hit, right? So he's my daughter's age.
Yeah.
Right. So you have World War II and the Nazi regime, all of that, and then you've got multiple Vietnam market corrections and wars and crashes and all these things, and he's like, hey.
Inflation was like double digit.
We all go through, relax, get a bag of popcorn, enjoy the show. So I thought that was an interesting perspective. We talk about all these things, but I think thinking about them strategically, but not in a stressful way.
Not emotionally.
Yeah, and it stresses me out, but like one of the things I always go back to is don't stress, strategize. So like, how do you take all this information, all these inputs and strategize to better yourself? And how do you look at it through the perspective of my grandpa Norman?
Well, it's true because I think people, we tend to be self-centered just like as humans.
Yeah.
And we're like, this is unprecedented. This is unprecedented.
It's not unprecedented.
The tariffs and the interest rates and the economy and the inflation and
it's just new to you.
Can you imagine though being like living through the Depression, World War II, the Korean War, Vietnam, like
Cold War? I mean,
the interest rates were like 13, like they were double digit interest rates. Like, and those people like, again, those people are like, you said, get the popcorn. And you always say this is more going off real estate, just philosophically. Everybody wants your time. They want you to hurry. Yep. They want you to respond. The guy's like, hey, what about that PSA? You're going to get back to us and get back to him when you get back to him. And at the end of the day, you got one life.
Yeah.
And we're all going to be, you always say this and it's dark because you're a dark soul sucking human, but it does make sense when you say in 100 years, we're all dead anyway.
Well, yeah.
So enjoy the ride.
Yeah, enjoy the ride and relax. We don't know what's going to happen. And here's the good thing about history and mindset and psychology is usually the fear is much greater than the end reality. Almost 99%. We saw it during COVID. We've seen it during multiple market crashes, multiple wars, multiple scenarios. Usually the fear is greater and more far-reaching than the end reality.
You're not going to be homeless under a bridge, I always say. It's somewhere between crazy amounts of success in that. There's usually a gray area.
That's right.
Yeah.
That's right. And you do love to be 0 and 1s. It's usually 0.5. Anyway, this is fun. I love
this is good.
Chats are multiple.
Yeah, hopefully this is valuable to somebody. You've been listening to the Mitch and Travis Hour Fireside Chat. Thanks for joining us for the 0 100 podcast. And we'll talk to all of you guys next week.
Later.